Hi, I'm Christine Benz from Morningstar. Actively managed mutual funds have been losing market share to passively managed products. I recently sat down with Vanguard founder Jack Bogle to discuss his views on the trend. As we've talked about, the decline in assets at actively managed funds has been quite striking. What's your take on what is the fate of active funds? Do you think that they'll just ebb away, or do you think that they will have a resurgence? In some future market environment, will they have a chance to outperform?
Well, actually, to give you the facts, the assets had not really dwindled at all. They've grown because the withdrawals, net withdrawals, $1 trillion in the last 8 or 9 years, have been more than offset by rising stock prices. So it's a little bit, they have a business that is hemorrhaging, but they don't know it because the assets keep going up. So at some point, I believe, as I said in my talk out at Morningstar earlier this year, I believe that particularly funds that are owned by financial conglomerates, those conglomerates buy businesses to make money for themselves. This is not complicated. If you buy a mutual fund manager for $1 billion, you're going to want to take out $200 million a year. That's for you. That's your objective in going in there. Your objective is not to serve shareholders, although you want to serve shareholders. There's no doubt about that. But with that kind of a carryover, you need to take all that money out. It's going to be very difficult to do. So I think these conglomerates will, over time, and maybe not too distant time, sell their mutual fund management companies, either make them independent, spin them off, because I do think that I made very clear that public ownership of management companies is a violation of fiduciary duty by definition.
Because you can't serve those two masters.
You can't serve two masters. And, let's be clear, the officers of the fund have a fiduciary duty to the fund shareholders, and the officers of the fund, who are also officers of the manager, have fiduciary duty to the management company shareholders. And that's the two masters. And as the good book tells us, for he who tries to do that will love the one or hate the other. And since we live in a monetarily oriented society, to say the least today, the one that will get the love is the one that makes all the money. Too bad.
One area where investors seem to have at least some faith in active management is in the fixed income space. When we look at flows, we see that, yes, the index products are seeing healthy flows, certainly, but so are the active bond funds. Do you think that faith in active management there is well placed?
Well, that's a really good question. I'm actually speaking to the Fixed Income Analysts Society Incorporated, FIASI, in New York on Tuesday. Didn't have enough to do next week, so I volunteered, not quite. The reality is that there's been a lot of drive in and out of bond managers with extraordinary performance. And Bill Gross is a classic example of that. Built PIMCO into a huge giant, and it's probably now, let me guess, that their assets are maybe 25% of what they were at the high. And then Double Line, another one, Jeff Gundlach, has been good, not as by the same kind of margins Bill was in his good years, but pretty good. And so Double Line is drawing a lot of capital. It's interesting, this business generally doesn't seem to care for mutual funds. And very few, we are the dominant. We have about a 25% market share of both municipal bond funds and taxable bond funds.
Vanguard does.
Yeah, Vanguard does. And that's about the same as our market share on the equity side. So sooner or later, cost takes over. And you can have flurries. And Bill Gross, I have a great admiration for him. He's not finding it easy at Janus to do the same kind of things he did before, although his portfolio is tiny in size there. And I think Gundlach runs about, let me just guess, around $30 billion, not a giant, but big. And they are doing things that I couldn't describe to you if I went to school for a year. And I say more power to them. I mean, every time I meet an active manager, the last words I ever leave with them is good luck. I want the person I'm talking to to have good luck, but all managers as a group have 50% good luck and 50% bad luck. So indexing is growing more slowly, admittedly, in bond area. And part of that is that the bond index fund is, I think, really too constricted in its basically formulation. The Bloomberg Barclays aggregate bond index, aggregate U.S. bond index, I think is the title now. And it's heavily, it's an intermediate term bond index. It's probably around 70% in governments and government agencies. So that's not where you get the extra returns. And I think we looked at it's about 20-25% in corporates. And I think that's not a balance that most people would intuitively pick. Now, what do I know? Sorry to tell you, nothing. But I would think a 50-50 corporate treasury would be a reasonable pick, and maybe not quite so short. But then, am I talking as an active manager, as an indexer?
Right.
Well, of course, this puts the indexer in a powerful position because he has a presumption, or she has a presumption, and that she has the right answer. And I don't concede that. The bond indexing is a complex, highly complex, I would say, matter compared to stock indexing.
You have suggested, though, that investors could reasonably add a little bit of a high-quality corporate bond fund alongside total bond market index to augment or perhaps offset.
Well, that's where we get the 50-50 that is in my book.
Right.
50% corporates, 50% notes, and you might even want to extend those notes, a little treasury notes. But there aren't, be very clear, there aren't easy answers to this. I mean, that might be great advice, or it might not. But the bond index fund, which is by far, our Vanguard bond index funds, there happen to be two identical, is around $310 billion. And I think the next largest bond fund is maybe below 100 billion, I'd just guess. So it's completely dominant, even more dominant in cash flow than in a percentage of assets, without being quite as perfect as I would like it to be. Now, I don't have to run the responsibility of doing it. Talk is cheap. And so I talk about it, but people here are going to have to make their own, Vanguard are going to have to make their own decision. But we've come a long way when you think of this $300 billion bond index fund dwarfing everything else. It's hard to say it isn't going our way.